if you look at TRU Truflation, after we saw a scare at the beginning of the year when Truflation popped up north of 3%, it's now, as of the time of this taping, back down to 2.29%. And I think that we're going to see real-time disinflationary effects begin to show up in the broader metrics that the Fed is following.
Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. It is so great to see you again. Great to welcome you back on the show. But I got to say, I am so sad that I am not in New York City. For folks who are watching and listening, I was supposed to be in New York for an in-person episode with Danielle, which is kind of becoming one of my favorite traditions. But we have snow here in North Carolina, and I don't think they have snow plows down here. So my flight got canceled, unfortunately. Yep. But great to see you nonetheless, Danielle.
No sand, no plows, no travel. But it's good to see you. Thank you for having me.
Likewise. And I'm sure we'll see each other for the actual FOMC day in March. But today we have the minutes. So I think let's start there just to get your reaction to the Fed minutes. Anything that stood out to you? Anything that surprised you?
Really, everything that we expected that they were going to say, they said, and that is, we don't know a thing. Inflation could go up, inflation could go down, the employment market could remain tight in their mind, because it's in their mind. It's not on the ground, or it could loosen up. One of the things that they did mention, though, was that they're going to be paying attention to the debt ceiling going forward, and that could affect the complexion and the runoff of their balance sheet. So I'll be paying a little bit closer attention to what Fed officials are going to be commenting on the balance sheet going forward as we kind of approach this debt ceiling, kabuki theater, as they say, all over again.
Yeah, it's interesting. Like how could the debt ceiling dynamics, how can that affect monetary policy implementation? It sounds like something folks do need to be paying attention to.
It is, and they do, especially because Treasury Secretary Scott Bessent has stated that he wants for there to be more Treasury note issuance going forward. He hasn't actually pulled that lever yet. It looks like we're still leaning a lot on Treasury bills, but to the extent that the Treasury is putting money out into the economy by way of lowering the balance of the nation's checking account. That's the easiest way to think of the Treasury general account. It's just like any other major entity, when you're sending out Social Security checks and Medicare payments, what have you, we have to have our own checking account. And when the nation hits kind of a stalemate with raising the debt ceiling, then the United States has to, in the absence of the ability to issue fresh debt, they've got to run the balance down. And when that happens, that tends to inject immediate liquidity into the economy, as opposed to the government borrowing more to fund its needs. And that can cover up, if you will, the Fed's quantitative tightening efforts, the Fed's efforts to shrink its balance sheet. Sometimes it's hard to see if you've got two cross currents, one shrinking, one injecting liquidity at the same time. So they said that they're going to be paying attention to that to see whether the pace of quantitative tightening slows or not. It truly remains to be seen. For my money, though, I'll just put in a let's go MBS. I do hope that they continue to roll off their mortgage-backed securities regardless of what's happening in the Treasury market. I think for the eventual natural operation of the mortgage market without the Fed having such a big footprint there.
Mm-hmm. Okay, that's an interesting point too, rolling off the MBS. Like, what are some of the implications of that? Could we get back to like a more normal housing market? Could that have an impact there?
That's certainly what we want. A lot of individuals would suggest that, we had a large bankruptcy today, a big electric vehicle maker, big electric truck maker, multi-billion-dollar bankruptcy. And we've seen actually the pace of bankruptcies for companies that have, say, between $1 million and $10 million in liability really ramp up into the new year. And of course, it's only February. And yet we've seen that. And so, and we're also seeing an increase in household bankruptcies. The reason I bring this up is that there are a lot of Fed officials who look at the stock market alone in isolation and say that financial conditions remain too easy. Well, if you ask borrowers who can't refinance their debts or access debt to refinance, they would tell you that monetary policy, if they were to come up with these words, is still too restrictive. So there's a big pull and push here. My concern, though, and since the last time we saw each other, is what's happening in the public sector in addition to what we're not seeing, which is a slowdown in the private sector pace of layoffs.
That's a good point. Okay, so the last time you and I saw each other would have been late January for the FOMC meeting, the first one of the year. As you point out, a lot of changes happening in the public sector. You're right. It's only February 19th, but I feel like so much has happened in the last 3 weeks that honestly, it's hard to keep up even. But I do want to get your take there because as you point out, slowdown in the private sector, we know how critical that is, but a big portion of the GDP has been coming from, government spending, even government jobs. What is your assessment there?
Well, so let's start with the private sector first in isolation, then just to make the point, then we can add the public onto it. There's a report out this afternoon that United Healthcare is offering voluntary buyouts to about 25,000 of its employees. To be fair, it employs 440,000 as of their last public filing, but it's still a large number of employees. We saw a similarly large report out of Chevron that it's going to be cutting 7,000 members. Nissan's going to be cutting 20% of its workforce worldwide. Of course, that'll affect jobs here in the United States. My point is, January actually saw a slight reprieve in the pace of private sector job cuts that were announced. They ticked down to 80,000. And I would say right now, the private sector alone with these most recent large announcements is going to be pushing 100,000. So that's kind of your starting point is you've gone from 80 in January to call it 100 in February. And we're not finished with the month yet. Thank heavens it's short. On top of this, we know that 75,000 public sector workers have accepted the buyout. And that on top of that, we're seeing one layoff announcement after another. Right before we started recording, we saw news cross that the Department of Defense is looking to cut 8% of its budget over the next 5 years. Again, if only a modicum, if only a portion of the efforts being made by the Department of Government efficiency come to pass, you're still talking about a good 200,000 jobs in 1 month, which any economist would call a shock to the system. And that's my greatest concern right now, as we're talking about household balance sheets and the New York Fed reporting that in the aggregate, household debt had crossed the $18 trillion milestone in the last 3 months of 2024. A lot of consumers are struggling, and the last thing you want to hear is that their income generating capacity is decreasing. If you're going on severance, that's one thing, but there have to be jobs that follow after that. And again, I go back to the fact that if we're still in a cost-cutting mode in the private sector, it's going to make it that much more difficult to absorb the excess capacity of workers coming out of the public sector.
Yeah, that's a good point, because I think the last time you and I spoke too, you pointed out, like, if you have a job, keep your job. Hold on to it.
Exactly.
Yeah.
And we're seeing, and that part's not changed. I saw a separate report out today that showed that the average Uber driver is making 8% less a week, somewhere in the neighborhood of $500 a week. We talked the last time we met about the gig economy becoming saturated. But if they really are making just close to $500 a week, and you've got so many others coming into the workforce looking for ways to supplement their income, this is not. It's not a good combination.
No. Okay. But just going back to like the Fed, even like they've talked about like the labor market. I think last time it was characterized as solid. How do you think that might change? Or let's see, how do we want to phrase that? How do you think that might change in upcoming meetings? Maybe that language even. And, that's one of their dual mandates as well. So just curious, like, how are you thinking about the Fed as it relates to like what's happening in the labor market?
So, we're going to have to wait and see how quickly what we're seeing in the private sector and what we're seeing in the public sector manifests in initial jobless claims. That's been an area of the economic data that really has been what you would call benign. It's been benign for many, many years now at this point, even though we've got continuing jobless claims at the highest level in 3.5 years. In other words, that goes back to what we were saying. If you've got a job, for heaven's sake, keep it, because if you lose a job, it's very hard to get another one. But what happens if, as I said, there's a shock to the system where you've got all of a sudden, instead of 100,000, 200,000 coming out in 1 month out of the workforce? Are we going to start to see a pickup in initial jobless claimants? If that's the case, I can promise you that will get the attention of the Federal Reserve. And we've also got another jobs report coming up before they next meet in March. And to the extent that we see kind of a retracement upwards in the unemployment rate, which would not surprise me, Fed policymakers could find themselves verbally pivoting once again and saying, gee, now we're going to have to switch gears. It's from sticky inflation to we need to pay attention to that employment mandate. It's not a good look, because in terms of consistency, the messaging certainly could not be characterized as consistent. But we go back to my base case for 2025, and that's that we're going to see more rate cuts than what the market currently has priced in as the Fed has to backtrack.
Interesting. Okay, so more rate cuts. Even, with inflation, the recent inflation report, do you think we'll see a rate cut in the March meeting or maybe later in the year?
So I think March is probably going to be way too soon. There's not going to be enough data to suggest that inflation is sticky or not, at least according to the Fed. But what we do know is that Chair Powell's focus has shifted to rents. We got a new report out today from, I believe, Apartment List that shows that the national vacancy rate has hit 6.85%. That's higher than it was in July of 2020, which was 6.84%. But the point is, we've actually got more supply in the apartment market than we've had at any time going back to 2018, 2019, which means that supply up, prices down. So we're going to continue to see rents, which Powell's saying he's following, come down. And in fact, if you look at TRU Truflation, after we saw a scare at the beginning of the year when Truflation popped up north of 3%, it's now, as of the time of this taping, back down to 2.29%. And I think that we're going to see real-time disinflationary effects begin to show up in the broader metrics that the Fed is following.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold, in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more.
Yeah, I want to hear more on that, like the disinflationary bit. How are you thinking about that? Where will you be looking in particular?
Well, first and foremost, as I said, if you've got a 40%, depending on the metric, or maybe a 25% input, every single inflation metric out there, the largest input is shelter. So we're going to be paying the closest attention to that. The Wall Street Journal had a good story out last week that showed 68 some odd thousand U.S. home sellers had pulled their home from the market, the highest level in years. And that tells us that there's pent up supply going into the critical spring selling season, such that we could start to see, downward pressure, not just on rents, but on home prices as well as we get into the spring. So that will be the biggest drag. And then what we're seeing again with income growth or lack thereof, you're seeing hotel rates come down pretty quickly. There was a huge spike in hotel rates that accompanied the fires out in California, but we're seeing a retracement there. and the ability of American consumers to splurge, to spend money in a discretionary fashion is clearly increasingly compromised as we see these credit card delinquencies continue to rise. And the same goes for auto loan delinquencies also being, nearing the highest level since the Great Recession. And I would add to that what we saw in the most recent quarterly report from the New York Fed. And that is, and the economists there noted, we're starting to see a sizable increase in prime level auto delinquencies. And I think that that's something that could be compounded in the coming weeks as you start to see student loan delinquencies reported for the first time in 5 years. These are individuals who did not qualify for student loan forgiveness. They simply make too much money. But since the pandemic hit, many of them have been operating under the assumption, I'll never have to pay these back. Well, as of April the 1st, kind of at the latest, that's when the TransUnions and the Experians of the world are going to start to hear about individuals who haven't been making payments since payments became mandatory in October of 2023.
Oh, I would imagine what that's going to do to the consumer, but also just the credit scores for folks.
You're already seeing reports of people who have been reported to the credit reporting agencies. You're already seeing anecdotes start to filter out on social media about the immediacy of the hit that their credit scores are taking. And we are a debtor nation. We are a nation that relies on borrowing to sustain spending, whether you're talking about essentials or discretionary.
Mm-hmm. You mentioned housing. It's interesting. So I mean, I watch it pretty closely just because I would like to buy a house, but I have noticed, Danielle, the inventory, it's not moving as fast as it used to. It used to just something popped up and it would be gone within a couple of days. I'm not kidding. Raleigh was like that. And I noticed the prices are coming down and the houses have been sticking around a little bit longer. Is that kind of a sign of what's to come then? It
is. In fact, Redfin released its most recent monthly data. Pending home sales, they're at the lowest level, I think, since 1995. So I think the buyers are finally wise to the fact that they're the ones who are in control here, not the sellers. And, the sellers wanting to maintain that control, that's caused so many of them to pull their listings off the market. But if it's selling they have in mind, they're not going to miss the window of the spring selling season. And I think that could be a moment where the dam starts to break, especially when you begin to combine in especially in Sunbelt states, the fact that there's way too much apartment inventory that continues to come out of the pipeline. We saw in fresh data on multifamily completions that they're running they're up 10% year over year, even though multifamily construction's coming down. The completions coming out of the pipeline are running about 735,000 of them coming out of the pipeline, in addition to the 500,000 that have hit the market every year for the last 2 years. And I bring up apartments because they're competing with new homes that are on the market. They're competing with sellers who are hoping to be able to get into that spring selling window and move that house quickly. But it's the confluence of factors. It's the three different sources of supply, whether you want to rent an apartment, whether you want to buy a new home, and home builders are still being very aggressive with incentive spending, or whether you want to buy an existing home. There are going to be three sources of supply competing with each other by the time we're rolling into Memorial Day.
That's so interesting. Yeah. And also, I mean, I feel like I also see so many of these apartment buildings going up, and I imagine they probably worked that out several years ago that they were going to build them. And I'm like, are there really enough people to live in those? I don't know.
Well, because they're nice apartment buildings, and that's something that's something that a lot of the people bring up. And we undeniably have a shortage of affordable homes in the United States. But with the secular decline that we've seen in the birth rate, and I'm writing about this week from my weekly quill, with the absolute collapse in the number of U.S. families with children under the age of 18, it's the particular type of home that people need. If you're single, or if you're just maybe going to have one or two children, you may not need that McMansion that the baby boomer no longer wants to be sitting on. One huge growth opportunity, I think, going forward is going to be senior housing.
Yeah, I could see that for sure. The senior housing bit. Are you thinking more like these communities for senior housing?
Yes. I mean,
downsizing?
Downsizing. That's exactly right. I mean, once you hit a certain age, you don't want to have to worry about
or going upstairs or all that stuff. Yeah.
Or even just, the kid mowing your lawn. There's just a lot of upkeep that is involved with owning a home that a lot of people, once they get into the latter stages of their life, they want simplicity. And, private equity swarmed into the nursing home space. So there's a dearth of supply there. And I think that we are going to be seeing developers looking increasingly to building affordable senior housing.
Yeah, it's an interesting play for sure. Okay, I want to step back, kind of framing up where we are, just because you highlighted what's happening in the private sector, what's happening in the public sector. Is it fair to say, do you think we're kind of entering or are in a white collar recession when you think about the types of jobs being impacted?
Yes, I think without a doubt. I think that we've been in a white collar recession. I think that the fact that the private sector hasn't seen, full-time job creation for the better part of 2 years is indicative of the white collar recession that we've been in. If you will, it was a watershed moment when Elon Musk, of all people, boy, his name keeps coming up. But when he was able to shed 75% of the headcount of Twitter after buying it, and the lights stayed on. I think that really was a signal to so many U.S. employers that they didn't need as many in middle management as what they had assumed that they did. And then, coming down the pipeline is artificial intelligence. And that fills in a lot of gaps as well, meaning, we could be looking at something of a barbell type of a bifurcated type of a U.S. Employment market where either you can outthink the machines or you do things that the machines simply cannot do.
In other words, do more of these trade kind of jobs, AI is not going to be a plumber. Those are great jobs, by the way, or an electrician, because it just can't learn those. It's not going to be able to do it or learn those tasks, but they're also super valuable, or your HVAC or something.
And those types, especially as we see the aging of America, those types of trade professions are going to be much more in demand going forward. Again, many senior citizens enjoy their independence. They're healthier than prior generations have been. They want to have independent living. They don't necessarily want to be in a retirement community, but maybe they want a smaller home. To the extent that we maintain independence in terms of that roof over our head, the demand for these trades, men and women. I had a female plumber come in my house about a year ago. I'm like, you go, girl, paint my ceiling all you want. You don't have to be a man. But to the extent that we want to maintain our independence in terms of our home, these individuals will continue to be in demand and not be replaceable by machines, with all due deference to companies looking at robots to replace human beings.
Yeah. Our plumber growing up was a literature major from the University of Virginia, and he was super duper smart and obviously an amazing job as a plumber as well. Okay, so I also want to bring this up with you. We have, I'm looking at the US debt clock, which now has a Doge clock on it. It's at 113.7 billion saved with Doge. You and I have talked about Doge. Has the number surprised you, how much they've been able to shave off in this? It's not even a month yet. It's February 19th, so not even a month.
Something tells me that because 24 hours ago that number was 50 billion, that they've plunked in an assumption of 8% savings in the Department of Defense and just kind of added to that clock. I applaud any and all efforts to get rid of waste in government spending. It's our money. It's the taxpayers' money. As efficiently as the nation can be run, let's absolutely do it. But let's get that debt clock to slow down as well. So to the extent that we're going to be offsetting what we save by by putting tax breaks out there, at the risk of being slaughtered on social media, I don't think we are a nation that is so impoverished that we can't have higher taxes, or at least a flat tax. At least a flat tax to where, we know we're all paying our fair share. And, I'll get behind Warren Buffett in saying we don't all pay our fair share. And so let's make the flat tax great again. But don't simply throw pork barrel spending out there, special interest spending out there. If you're going to save money through the Department of Government Efficiency, let's make those gains stick.
A flat tax would be quite nice. As someone who's doing taxes right now, and it gets a little bit more complicated when you have like different streams of revenue or whatever, that I could definitely get behind that. I'm sure there are folks who would not like it. Maybe, I don't know, the accountants probably wouldn't like it.
It would put a lot of accountants out of business if the tax code was like a simple
super
one pager.
Right?
You pay you pay a flat tax.
But we would all be a lot less stressed. I would say that.
We wouldn't have to worry about those job cuts at the IRS.
There you go. Okay. I saw another headline. I had to be careful too with headlines, Danielle, because things move so fast. And it's like, what are we verifying or not verifying? And but I did see a headline today about Elon Musk saying that Doge is considering sending a $5,000 refund check to U.S. taxpayers, I guess based on like the savings, like the projected savings of Doge. I don't know if it's true or not, but maybe let's use it as a hypothetical. Like, what would that mean? Like, if that happened, if we got suddenly $5,000 checks.
Well, I think that would mean that we would have inflation. Mm-hmm. And, what people don't realize is that we've taken this idea for a test drive. We had many U.S. families that were receiving $3,000 a month in child tax credit that were just being deposited into their bank accounts. And the outgrowth of that was inflation. So if you are talking about a world where your average Uber driver is making $500 a week, where people, collecting continuing claims are making less than that a week, maybe $300, maybe $350 a week. When you pump that money into the economy, it's going to be spent, and it's going to be spent immediately. And that's the same dynamic that we saw take hold with the first and the second and the third stimulus check. So it all has to do with the transmission mechanism. And if you hand out cash, you will have an inflationary problem on your hand, and it will happen quickly.
Okay. So to sum up the conversation here, we got a look into your views of the economy. I think white collar recession. We are expecting on your end, the expectation is more rate cuts than the market has priced in. Can we just kind of tie together more of your outlook on the economy? If you would like, feel free to throw markets in there as well. I know they're separate, but if you have a take on markets, please feel free to throw that in there as well.
So I actually started doing a little bit of research on the thrift savings plan that government employees pay into, and it behaves a lot like a 401k plan. So I would add a word of caution that to the extent that we continue to see layoffs in the private sector, individuals no longer contributing to 401ks, to the extent that we continue to see sclerosis in terms of new entrants to the job market, I would be mindful of demographics. There are more than 11,500 Americans who turn 65 every day. And the market is a beast that runs on the underlying platform, the structure of passive investing, and passive investing not slowing down. And passive investing won't slow down unless you start to have an imbalance the other way. For years and years and years, as far back as we can see, there have been more new entrants to the job market, more individuals who continue to contribute to their 401ks, more than offsetting individuals who are no longer contributing to their 401ks, most of whom used to be in an expanding economy, retirees. But if we have If we have a large influx of individuals who are no longer contributing in a passive way, in addition to the retirees that we have, then you could possibly begin to see an imbalance. And that would certainly get the market's attention. So I will be attentive to that, because it's not been a delicate balance for decades. It's been a pretty simple one. More in, less out. More inflows, fewer redemptions. But if that dynamic was to shift, if there was a shock to the economy where there were enough people leaving the workforce in addition to retirees, then you could begin to upset the balance that is the support network, is the support structure for passive investing.
Interesting. Yeah, that's something that has come up on this show, is the importance of paying attention to that passive bid. Mike Green has brought it up. Bill Fleckenstein has brought it up, and others. And what can remind me what it was called again that you were looking into? You said Treasury saving. What was it again?
Oh, the Thrift Savings Plan, TSP. TSP is, my gosh, my mother worked for 37 years for the Social Security Administration. I'm proud to say, fighting disability fraud. Yay, Mom. But she retired, and part of her retirement is this Thrift Savings Plan that she had, which was very new when she was leaving the government years ago, but it has become a go-to where the government matches what you contribute in the same way that an employer would match your 401k contributions. So, but that is the defined contribution plan that U.S. public sector employees have used, and it is the government's answer to a 401k plan, but it generates passive inflows in the same way that a 401k plan does. So you don't want to have any kind of an interruption or a shock to this process of automated inflows into the market that keeps the stock market elevated.
Good point. Danielle, I have to say, once again, I'm sorry I couldn't be there in person. I know Matt is probably enjoying having you in studio today, and I know you'll have another hit as well. So I look forward to our next meeting. But until then, let folks know where they can find your work, follow you on social media, support your work, subscribe to it, and any parting thoughts, anything that you'd like to leave this audience to think about. The floor is all yours.
Well, thank you. Please do follow me at Twitter if you don't already, at DiMartino Booth. And if you stop hearing from me when you are on my Twitter feed, that means that you have been quietly muted. So try and be polite, because it pays. And if I do go silent, it just means I can no longer hear you. I digress. We have so enjoyed, everybody at QI Research, the growth in the readership of the Daily Feather. We've been running a 20% off of the annual subscription, and our community has grown so much coming into 2025. I do appreciate the growth of the community and the feedback that's provided at dmartinobooth.substack.com. And my parting shot would be this. Anybody who you know who is losing their job. I know somebody who was concerned that they were going to lose their job at Southwest Airlines and managed to not be part of that nearly 2,000 who were cut for the first time in 53 years. The layoff, this layoff cycle is spreading. It's spreading into the public sector, and to the extent that that we are the good people who we are. Be attentive, please, to the economic backdrop, and always be mindful of looking to give a helping hand to those who are in need. As you start to see these headlines proliferate, there are always people behind them. And please bear that in mind. Thank you.
That is so well said. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Wonderful having you back on. You're obviously always welcome. We look forward to it every single FOMC. And this was just an extra special treat to get you for the FOMC minutes. Thanks again for being so generous with your time, all of your knowledge, your ideas, your wisdom. Really appreciate you, and can't wait to see you in person next time.
Likewise. Take care.